video, and this is a live stream and you will be able to ask questions at the end of it. I'll just summarize what Jerome Powell said and what I think it means for markets. It's got to be said, the market reaction so far has been quite brutal in terms of an equity market sell-off. But let's just look at exactly what happened and try to figure out what's going on based on what Powell said, but also I'll chip in with my views. So I think first of all, the first thing to say is that the US economy is in pretty strong shape, and Powell was very optimistic about the future of the US economy, how it's outperforming its peers in the G7, the other rich countries, and also inflation is coming back under control. So that's the good news. There has been an uptick recently, which we'll see in a moment when we look at the actual inflation numbers, but it's way below where it was previously. So they haven't won the battle yet. They're still being cautious. And this tale of sticky inflation, mostly in the services components of inflation, particularly housing, which makes up a big component of the consumption basket in the US, that's being really difficult to get rid of. And that's taking longer than expected to subside. There's always an excuse as to why shelter doesn't come down more quickly at every one of these press conferences, but it just isn't happening yet. And there were some nice metaphors. So let's see if I can dig out one of those metaphors about inflation uncertainty. And we'll also look at what the FOMC dot plots showed, because that's just been updated. And that's kind of interesting as well, because all the dots have moved upwards. So certainly the Fed is now seeing a higher inflation environment looking ahead than it did at the previous two meetings. And consequently, its policy has also been revised upwards, its expectations at least. So yeah, let's actually start kicking some of that data around now, just have a look at what's going on. And I can probably show that better here. Here we go. And there we are. So bear in mind that Powell is not going to be around forever. So it's unlikely that Trump is going to get rid of him while he's still in office. It would require a law change to do that. But his tenure ends at the end of, in the middle of May 2026. So he's got a while yet. He's going to be around, but it's unlikely that Trump is going to keep him in office past May of 2026. He'll probably appoint someone who's more likely to keep interest rates low. And of course, that could create all kinds of problems if his policies do turn out to be inflationary. Although probably by May 2026, the spike in tariff-driven inflation might have started working out of the system by that point. And we'll also talk about looking through that spike, because that's one of the things that was discussed today. So this is the statement that came out half an hour before the press conference, where they basically just say what they've done. So they've cut rates by 25 basis points, 0.25%. That's pretty much what markets expected. And they think that the risks are kind of even of stifling growth in the economy versus letting inflation run rampant again. So roughly even risks at the moment. And this is why they've slowed down, apparently. And yes, the SARM rule, which is a measure of whether the US is currently in a recession created by Claudius SARM, that looks at the rate of increase of the unemployment rate in the United States. Previously, it's been a really good predictor of recessions. As you can see, it's still on the cusp of predicting that we're in a recession. It went just over briefly, and now it's ticked back down. So it's on the border of triggering. But clearly, if you look at US data, it's not in a recession. So unemployment is, the jobs market is weakening, it's slowing down, but it's not a full-blown recession that we're seeing in the US right now. So let's have a quick look at those economic projections, which have just been updated. So this is the infamous dot plots. Of course, it's not a prediction of what the Fed is going to do. It's just the individual opinions of the FOMC board members. So each of these dots you can see is their expectation for the federal funds rate, the policy rate, in 24, end of 2024, end of 25, 26, 27, and over the longer run. So you can think of this as a kind of longer run neutral rate. So where are we heading? We're heading towards 3% according to the Fed. That's where it'll be a kind of neutral rate, which won't increase inflation or decrease inflation. It'll just keep things stable. Currently, we're well above that. We're 1.5 percentage points above that, even after today's cut. And what the Fed is expecting is 2 cuts in 2025 and 2 cuts in 2026. So in total, that'll take us 1 percentage point down over the next 2 years. So that's a pretty gradual reduction in interest rates and a Fed that's very cautious. The numbers you can see in black here are what the expectations were at the previous meeting. So you can see that these have been revised upwards quite a bit, and that's because of higher inflation numbers and more obstinate service inflation and that naughty housing sector which refuses to do what the Fed says and reduce its inflation rate. So yeah, certainly revised upwards, and markets do not like that because remember, higher interest rates, bad for growth stocks, and a huge swathe of the US equity market are mega cap growth stocks. So not good news for the equity market really as we look at these change in expectations for the Fed. So let's take a look at what the market thought was going to happen and then what actually did happen. Make my face a bit small here. So this is how the expectations looked in September, not so long ago, remember, just 3 months, just 1 quarter. They expected the first cut to happen in September, which it did. They expected a jumbo cut, which it was, but then they expected cut, jumbo, cut in successive meetings. Now let's jump 1 meeting forward and suddenly it's not looking so cutty. It's just looking a little bit cutty, and that was in November. And now we look at it and we see just 2 cuts over the course of the next 3 meetings. Well, that includes today's meeting. So over the course of 2025, just 2 cuts, which is in line with what the Fed's summary of economic projections, the dot plots, told us as well. So it's always good when you see this synchronization between market expectations and the FOMC expectations, because there's not going to be a shock later on, hopefully. So the market expected with a 99% probability that the Fed would cut by 25 basis points, and it did. So no surprises there. Now, let's have a quick look at the inflation rate, because that was kind of interesting. Yeah, you can see that it is kind of ticking upwards here. Certainly not falling as much as the Fed would like. And that's a worrying sign. And if we look at PCE inflation, which is the measure that the Fed actually looks at, the personal consumption expenditures, yep, that kind of ticked up too. And you can see that core inflation, where you strip out the volatile components, that seems to have stabilized at 2.8%, which the Fed doesn't want to see. So not great. The labour market's not as tight as it was. Non-farm payrolls was very strong recently, which is worrying, and which may have played into the Fed's decision today to be a little bit more hawkish. Not good for equity markets again. And if we zoom in on the monthly changes in non-farm payrolls, you can see that due to the hurricane, it was pretty grim at the previous print. But the most recent print was 227,000, which suggests that the employment is increasing in the United States. That's more than enough to absorb new entrants to the jobs market in the US. So overall, I mean, I think it's looking fairly worrying maybe about next year, because remember that a lot of Trump's policies are inflationary, so tariffs are inflationary. And one of the questions, which was kind of interesting, was, can you look through this tariff-generated inflation? Because it's not real, right? It's not about the economy itself. And Powell's response was that if you look at the September 18 Teal book, now what is the Teal book? It's a document split into 2 sections, which basically informs the FOMC members just before they go into the meeting about what's the state of the current, what's the current state of the economy, inflation, growth, using many different measures. So what's the status of things right now? And then the second component is all about what their policy could be and also the frameworks of their policy. So from their point of view, it's really useful because it informs them before they go into the meeting. And you'll see that teal book probably reflected in the summary of economic projections. But Powell's point was that if you look back to 2018, they conducted some simulations looking at the effects of tariffs on inflation and also what monetary policy response should be in response to that. And according to the two different simulations, you either should look through the spike or shouldn't. But he was a little bit cagey about that. But he then said, well, we don't know what the policy is going to be, so we'll make that decision when we have the actual policy. So a bit of a cop-out, I think, from Powell, but an interesting one. You know, will they look through this tariff-related inflation or not? Which is interesting. The possibility that they might. And if they did, obviously that would please Trump because he could implement his tariffs, he could make them very severe, and yet the Fed wouldn't necessarily raise interest rates from where we are here, and that would be good for the stock market, that would be good for the economy. Maybe it would cause overheating of the economy, maybe not, but that's what the Teal book probably was trying to gauge. Another interesting question was about building a reserve of Bitcoin, and Powell pointed out the Fed isn't allowed to hold Bitcoin. He said that's the kind of thing for Congress to consider, but we're not looking for a law change at the Fed, i.e. we don't want to own Bitcoin, you know. So he's not interested in that. The question about what's the biggest challenge to the economy under the next administration? And Powell said, I feel very good about where the economy is. Honestly, I'm very optimistic about the economy and we're in a really good place. Our policies are in a really good place. I expect another good year next year. So very positive. Certainly, I think that's justified by the data in the US right now. He repeatedly pointed out that we're significantly closer to neutral because now they've cut 100 basis points, which is quite a chunky fall from their peak federal funds rate. And he said today was a closer call in terms of deciding what to do than in November. So it's clear that they're kind of slowing down. And there was a really nice metaphor, let me find it, about fog. So he was saying it's kind of like driving the fog. The question basically was about inflation uncertainty, because what's not clear is what Trump's policies are going to be and subsequently what effect they'll have on inflation. If he really stimulates the economy, which is quite likely, and the economy at the moment is in pretty good shape anyway, you would expect some kind of overheating. But Powell's response was that yes, there's greater uncertainty about inflation, so it's just common sense that you're going to tread more carefully. You're going to cut more cautiously, and it'll probably take a greater amount of evidence to make them cut. So they'll probably stay here for some time, is my belief, because of this foggy driving metaphor. Or walking into a dark room was his other metaphor, which I thought was rather nice. So yeah, let's turn it over to questions briefly. Well, I say briefly, what I mean is that Teddy's going to come upstairs, the star of the show, and he's going to eat some treats, and then he's going to go back downstairs and mug Laura for biltong. Because what he does now, he actually starts whining the minute he hears me rattle this thing, because then he can shoot up the stairs, get his treat up here. He then runs back down and gets higher quality biltong. Very good biltong from the Amersham biltong shop. So let's summon Ted. If I rattle this. He was like a shot. Were you up there waiting already? Good boy. He had to go to the vet today because he's got a zit under his chin, haven't you? You worried Daddy very much. But he's absolutely fine. There we go. Sebaceous cyst, Ted. Let's feed it. I'm going to stand up. Oh, you're so clever. Good boy, good boy. Should we do one more trick? One more stand? You have to stand. Don't use my leg. Oh, very good. Clever sausage. Well done. Oh, he's very good. Very good at that. Let me do one more treat, and then go and get some built on. Yeah. Oh, good boy. Very good. Brilliant. What did you think of Powell's speech? Dovish? Hawkish? He just wants built on. Go on then. Good boy. There's Laura whistling, and he's off down the stairs. Patter of paws down the stairs to get his treat. Great. So I have been bleating about this on, I don't know what you call it when you create a message on Blue Sky, but anyway, I've been putting some of the comments on Blue Sky. So, yeah. Some of the interesting ones. I noticed that he's wearing a dovish tie. So when he wears the purple one, it seems to be a signal. Don't quote me on that, but you see, that's his dovish tie, I'm sure of it. So this was the metaphor, which I liked. It's kind of common sense thinking that when the path is uncertain, you go a little bit slower. It's not unlike driving on a foggy night or walking into a dark room full of furniture or Lego, as I remember it. You just slow down. Yeah, so if you do want to follow us on there, why not? So we've got a starter pack, and we've also got a stream, which is financial news, which you can search here, and that just follows the people who I think are most useful for investing news. And there are now so many of them on Blue Sky, so I don't use X much anymore. Anyway, so that's another place where you can find out what we do. We'll also post on X, of course, so we cross-post on the platforms. Back to me, and we'll turn it over to your questions. Now, please do like, please do subscribe. I'm always told to say that. I always forget. And remember, you can join our community. You can chat to us anytime you like on Mattermost if you're part of our premium website membership, where you can find out more. Just go to pensioncraft.com/membership, and we discuss everything really. And it's a very friendly community. In fact, at the moment, we're voting on who is going to get free lifetime membership. So the most helpful person, every once in a while, we vote for them. The members vote for them. And whoever's thought to be most helpful, whoever gets the most votes, they get lifetime free membership of our premium tier. So that's, I think it's just a nice way to thank people for being so helpful. Because really now, by the time I look at the chat channel, 2 or 3 people have already answered the question before I can answer it. So that and better than I would usually. So that's great, and we're trying to encourage that, which I think is good. Okay, so over to you in the questions. So if you are one of our supporters on YouTube, you get pushed to the front of the queue. Please do super chat. Again, you'll get pushed to the front of the queue, and we'll answer your question first. And of course, we are a business, and these treats are not free. Buffalo treats. Oh, just be glad you can't smell that. Oh. Tangy. Right. So the first question is from Amir Ketobchi. Thank you, Amir, for your super chat. He's always at our live streams, and it's always nice to see your face and your questions. He says, are you optimistic about the UK's prospects in 2025? Merry Christmas and a Happy New Year. Keep up the good work. Thank you, Amir. Yeah, I think at the moment it just looks pretty bad for the UK. So some of you know I've got a small cap UK stock basket. So I do single stocks in my fund portfolio, and I've selected them based on strong fundamentals, right? So let me show you actually. Why not? Why not? So this is my basket, and I'll show you how I made it. So these are fundamentally selected stocks, right? So just give me a minute to fire this thing up. Because it's really about the stock market, isn't it? I mean, the economy is kind of interesting, but what we really care about is markets, so the equity market. And what I've deliberately gone for is the most cyclical of cyclical stocks, which are small caps and based in the UK. So the UK market's cheap, UK equity's cheap, I mean, and I'm looking for stocks which are even cheaper, but which are fundamentally sound. Their balance sheets are good, and they are a turnaround story, so they've got momentum as well. How do I do that? Well, I use a Stockopedia screen. Obviously, you can use any system which has fundamental data, but I just really like Stockopedia. Now, this is what my screen looks like. Let me just pull up the small cap value momentum screen. So this is the screen I use. So alongside me here, you can see the criteria. So the quality of the stocks balance sheet has to be high. So the quality rank has to be greater than 50. And this is a ranking across the entire UK market, right? So 50 means that it's roughly average for the UK in terms of quality of its fundamentals on its balance sheet. Value rank, which is greater than 50, which means it's cheap. So value rank of 100 would be the cheapest. 0 would be the most expensive. And then momentum rank is whether the earnings are turning around and the price is turning around. The market cap constraints are that it's got to be greater than 100 million, the market cap. So I don't want absolute tiddlers, but I don't want less, it has to be less than $1 billion. And then the spread, very important for liquidity, as I discovered, has to be less than 500 basis points. So less than 5% difference between the buy and sell price. So I can sell the thing if I need to. And then I choose 2 sectors, 2 stocks from each sector. So at the moment that would be MHP, MP Evans for consumer defensives. And then financials would be Blackstone Loan Financing and Jupiter Fund Management, for example. But the ones I've got in my portfolio are here. And it's just been awful, right? It just keeps falling. So at the moment it's quite depressing. But to answer your question, you know, am I optimistic about it? Yeah, I am still optimistic about the UK. I wouldn't hold the basket if I wasn't, because it's such an unloved market in the UK. It's so cheap, and fundamentally a lot of the stocks are pretty good. And the economy in the UK isn't as bad as people expect, I think. A lot of Labour's policies are being slagged off at the moment, but I think that actually growth could turn around in the UK. I'm pretty optimistic about it. And, you know, otherwise I wouldn't have this basket, right? Why do I think that? Well, I think the UK is still very good at exporting services, and the growth of those services is something which I think is going to underpin UK's competitive advantage. Okay, we've got no tech, but we're brilliant at a kind of miscellaneous category of services because we sell those services across the world. Being English speaking certainly helps. Having a good rule of law helps. So English law is used all over the world for commercial law. So, you know, I think that, and now we've got political stability, you know, whether you hate the current government or not, there is more stability, I'd say, less kind of crazy policies, and that's going to be a positive as well. Unfortunately, the trading relationship with Europe means that we're not a gateway to Europe anymore, which would have strengthened us for foreign investors. So I think that will still restrict foreign direct investment. But, you know, on the services sector, I think we're really strong. Things like producing films. You know, we've got a really good film industry here in the UK, and people love our content. And again, that's one of the benefits of being English speaking. So I think there's a lot going for the UK. Financial services, maybe even some fintechs could grow out of the UK and become dominant globally, like Revolut. That's a good example. Um, Unfortunately, many of them choose to list in New York, but hey, you know, it's still a benefit to the UK when you grow these companies and they go global. Hopefully, some of them will come back to the UK, but at the moment, the listings are still shrinking. There was an article about that at the weekend in the FT. But look, yeah, I'm optimistic. I think the economy could still grow pretty well. I think some of the targets that Labour have got are kind of unlikely to be met. For example, 1 million homes being built over the course of their parliament, of the next parliament. But I think the growth policies are reasonable. The structural reforms are reasonable, and spending on services, on things like infrastructure, things like broadband. Yes, I want fibre to my premises in Holmer Green. I always say that. All of that, good policies, I think, which could turn things around. But we'll have to see. So yeah, positive. Why not? The next question is from Benjamin Fletcher, also a super chat. Thank you, Benjamin. Awesome. Laura's typing something. Oh, that's so kind. Oh, Benjamin Fletcher says it's a donation towards Teddy's vet bill. It wasn't cheap. It was 56 quid, I think, just to feel here under his chin to tell me he had a zit. Yeah. So anyway, I think we're going to have to pop it. Oh. But I think he scratches it, so that was what pops it. So it's not pleasant. Sorry to burden you with that. But he's fine. He's in very good shape. And we've got another super chat from Amir Ketobchi, who says the S&P is down nearly 3% just now, off a cliff after the Fed announcement. Could you explain why in simple terms? Thanks, might have missed it. Okay, so brace yourselves. Here we go. Now, there's one explanation which is wrong and one explanation which is reasonable. But let's start with the reasonable one. So if you buy a stock, what you're buying is a claim on its future cash flows. You get some of those in the form of dividend, and it generates those and grows by reinvesting back into the business. So that's what you own, a growing thing, a growing stream of cash flows. Now, if interest rates are higher, the cost of funding is greater, the cost of capital is greater if the company has to borrow money, and that tends to slow down growth. So that's a problem. If households are indebted, also increasing interest rates takes money out of people's pockets because they pay more on their mortgage if they've got one, or if they have debts which they're paying off on their credit card, that's going to become more expensive. So effectively you're making people poorer, that reduces corporate earnings, and that slows down growth. So who's this going to affect most? Well, it's going to be things like consumer discretionary sectors, the consumer discretionary sector, so stocks like Amazon, all those things you don't really need. You do need to eat, but you don't need to buy, junk off Amazon. So consumer discretionary is going to be affected. Tech growth stocks are going to be affected because they tend to be quite growthy, and growthy stocks are massively negatively impacted by higher interest rates because that growth is underpinned by cheap borrowing. And if the borrowing gets more expensive, then that's bad news. So that's the kind of correct answer, I think. Those are the mechanisms by which growth stocks get hit by higher interest rates. The kind of incorrect explanation, I think, is to assign duration to stocks. Yes, growth stocks are more negatively impacted than value stocks when interest rates increase, but I think assigning duration to stocks is kind of silly because there is no strong correlation. It's not like a bond where you can work out to the second decimal place how an increase in interest rates will push the price of the bond down. There, the inverse relationship is really clear. For stocks, I think, yeah, you could call it duration, but people say that growth stocks have a greater duration than value stocks. It's kind of true, but it's nothing like duration in bonds, which is a strong mathematical relationship. It's a kind of fuzzy negative correlation that you get for growth stocks, but it gives you the idea, which is that higher interest rates, bad for growth stocks, and that's why we had a horrendous sell-off today as a result of the more hawkish dot plots from the Fed. It's odd though, because markets were kind of expecting this. If you look at what the Fed funds futures expectation was, it was 2 cuts, and that's exactly what the summary of economic projections said. But we did see a change from the previous summary of economic projections, an increase upwards. So yeah, that's what changed, and the market didn't like it. So not great. But I hope that kind of explains what went on and why we got a big sell-off. Growth stocks hate higher rates. So let's turn to the rest of you now, because we don't have any more super chats. Please do super chat, because obviously okay, MS says, I really hope you remove the dog segment. Okay, that's not going to happen, sorry. I always think it makes a nice break, and it gives people a chance to think of questions to ask. But look, there we are. Oh, here we go. Octavian Guzu says, weren't bonds supposed to hedge for stocks? It seems the opposite happens, as today both TLT and SPY fell. So let's have a look at TLT. And we'll look at its price change today. TLT ETF. Here we go. Hopefully you can see this. So this is TLT, and this is the 20-year plus US Treasury Fund. And you can see it did sell off, so it fell from 90 down to 89, so it lost 1%. So presumably the yield curve at the long end of the curve moved up by 1/20th of that, because the duration for these bonds will be something like 18 to 20 years. So the yield curve moved up by, so if that's 1%, it'll be 1/20th of 1%, so about 5 basis points. It doesn't take much, because these are really sensitive bonds. Why did it fall? Well, because interest rates were expected to increase, so the Fed was more hawkish. That's bad for bonds. It's bad for equity too. So the key thing to understand in this negative relationship between bonds and stocks is, if the reason for them to change their price is common to both, then what's going to happen is they'll fall together. So what could cause that? Higher inflation, toxic for bonds, toxic for equity. So bonds don't hedge equity if there's an inflation spike. A more hawkish Fed, that's bad for stocks, particularly right now, which is when the US is so growth focused. We've got a huge concentration in the mega cap, Magnificent Seven. What's kind of interesting as well is Bitcoin, because that fell also. So if you look at Bitcoin Trust, that fell 6% today. So it is very much just a levered version of NASDAQ. And the two track each other very closely. In fact, I've got a video coming out where I use that as a measure, a fair value measure of exuberance for Bitcoin, which I think is kind of interesting. And Bitcoin's looking expensive according to that measure right now. You compare it with 3 times daily levered NASDAQ, and it tracks pretty closely. And yeah, so you can see that Bitcoin also not a great hedge for equity. And you get these shocking things. Even BlackRock is saying that there's a negative or that Bitcoin's a good diversifier for equity. But just look at that, 5-6% fall at the same time as equity sells off. So I don't buy that. So NASDAQ down about 4, small caps down about 4, NICE composite down 3. Yeah. So yeah, it depends. The reason, the times when it does hedge is other shocks, right? So what could other shocks be? Well, look back to 2008 when it was the global financial crisis. Bonds were a brilliant hedge. They didn't just hedge equity; they rallied during the course of the huge sell-off because people were scared and they ran to treasuries for safety. So if it's some kind of risk off move generally, if it's risk appetite that's decreasing, people are getting more cautious, then bonds are a great hedge. But if it's something like the debt ceiling being hit, well, that affects treasuries and stocks. So again, the correlation would be positive there. So really you have to understand the cause of the sell-off in order to know whether bonds are going to be a good hedge. But remember, you can always go for money market funds, and those won't have fallen, right? So what is it called? Vanguard's Money Market Fund. Yeah, I'll try and get the US one. Here it is, VMFXX. So, yes. So I don't think this has intraday pricing because it's a mutual fund, unfortunately. But I'd expect that wouldn't be affected in the least. This is what it looks like, by the way. This is what I was looking at. So it's VMFXX. But if we look at that tomorrow, you'll see it hasn't fallen at all. It's always worth $1, and it'll always be worth $1. So that's, yeah. So if you don't want to sell off, if you don't want any duration risk, then you're still being paid pretty well. Even after the 25 basis point cut from the Fed today, you're still getting a reasonable yield on this, 4.53. That's going to fall by 25 basis points, so it'll probably fall to about 4.25% going forward. And the Fed's probably going to park it here for a while, the Fed policy rate. So I'd expect that to continue to churn out 4.25% return for some time. So if you don't want, oh sorry, I should have moved that down. I was pointing to this, the 7-day SEC yield. So if you want safety, that's going to give you safety. With duration, there's always a risk that it'll be a common risk to both equity and bonds, so the hedge may not work. But money markets are as safe as it gets. Right, next question. Do we have any super chats? Yes, we do. Okay, and it's the usual suspects. Okay, so it's Leonard von Nebelschutz, who I can't pronounce the name of, unfortunately. He says, how kind, a Christmas present to get stocks cheaper. Gotta love that, yeah? So that's the way to think of these things. It's a sale. Stocks were overvalued, and if you're still buying, you've got a bargain. Well, not much of a bargain because it's still expensive, but valuations were crazily high. So I think that's the right way to frame a sell-off, which is it's a sale, and that means you buy. So it's not the fact that, it's never going to recover from this. If we were to look at the stock market in 20 years' time, this blip won't even be visible, right? You'll just see a pretty strong upward growth is what I'd expect, if it's anything like the past. So yeah, this is a Christmas present because I saw somebody say that this is Powell's the Grinch. Let's see if I can find the tweet. It was quite funny. Powell is the Grinch. Where is it? Here we go. So here's the Grinch Powell, which I thought was quite funny. He's got a nice dog. Sorry, back on dogs. But look, if anything, he's given us a Christmas present, so that's the way to think of it. Made stocks cheaper. Right. What else have we got? We've got another super chat, thank you, from Stevenson720. These streams provide value. Thank you. I appreciate that. Thank you very much, Stevenson720. And yeah, obviously I hope our videos provide value as well. We put a lot of work into them. And our community too. I think you should check it out because People find it quite helpful to have people to talk to. What people tell me, interestingly, is they can't discuss money and investment with their family. They can't discuss it with their friends. So it's kind of like a secret interest in a way, because people just aren't interested to discuss it with them. So our community provides a place where you can discuss it with other people. Men, women, old, young. We've got a fairly broad spectrum of people. We'd like to have more women in the community, but we do have some now. I think because of a post on Mumsnet, which recommended us, and we got some women who joined us as a result, which is great to see. But if we look at our statistics on YouTube, it is quite male biased, which I don't like. I'd like to have a more kind of even, normal community in terms of gender divide. Anyway, back to your questions. How are we doing for time? It's getting quite late, so we'll just have a few more questions and we'll finish. Vanguard, what to do? Take balance up to 32k or leave. Any concerns 385k protection levels spreading across platforms or not? So this is Alex M. Now, if you're not aware, in the UK, what Vanguard has done is impose a minimum fee of £48 a year. Now, previously, the fee would just scale up with your investment. So if you invested £1, it would be almost zero, the fee. If you invest £1 today, or actually January is when the new fees come in, you're still going to have to pay that £48 every year, even if you've just got £1 invested. Why have they done that? Well, they say because it's very expensive to create an innovative platform and to be able to carry on servicing their clients at the current level, i.e. to have a good call center, good messages to help sort out your problems. They have to pay for compliance, of course. They have to keep the website running. They have to create new features. All of this stuff costs a lot of money. And they say that's why they've got the minimum fee. Now, I suspect what many people do is they split their money across multiple platforms. And so even though they've only got, say, 20k on Vanguard, they're going to have 20k on 2-3 different other platforms, just in case there's a failure of one platform, which you can kind of understand. But you will pay more fees if you do that. And now you'll pay a lot more fees if you just have a little bit on Vanguard as a proportion of your investment. So I think it's not a good thing that they've done, because remember that people start off with no money at all, usually. So it's like they're saying to all of these people who just getting started with investment, well, we're going to whack you on the head with a big fee. And that's not the message you want to convey to those people. You want to encourage them. And if they are really going to democratize investment in the UK, well, that's not the way to do it. But I notice at the same time, their managed product, where they tell you what they're going to invest in, you just give that right to them to decide what to buy on your behalf. They lowered the fee on that managed account. So if you use the managed ISA, the same day they announced the increase in fees for their platform, they also announced that the managed fee would fall. I think it was from 0.2 to 0.1%, something like that. So that was interesting. They're going to trying to push people towards that managed product. Although I'd never use that. I use my own judgment about what to buy. So yeah, a bit of a shock and a lot of anger. One more question. Let's see. No more questions. Super chats. Do you think the S&P equal weight will turn around? Mega caps still dominating? Yeah. I think if it's the case that we now enter a period where we've got a more restrictive policy for longer, and we have less growth-friendly macroeconomic environment, so what would that mean? Certainly higher interest rates, but higher inflation would also be bad for these growth stocks. So, that's the kind of perfect storm. An overvalued growth sector at the moment, combined with higher inflation, combined with higher interest rates, that's the kind of environment where value might get its foot back in the door and start outperforming again. But, it's been so long and we've had so many false dawns with value. But that's effectively what you're buying if you buy a equal weighted version of the S&P. You're buying a value version of the S&P, because the stuff at the smaller end of the market cap scale is the stuff that's generally cheaper. It's the mega caps which are really dominating and making the index expensive. So having that tilt to smaller caps will probably help. But I've got a US small cap portfolio because I think a lot of these policies could help. Protectionism could help US small caps because they sell most of their products into the country. They don't sell internationally. So as long as they're not importing goods, which then become more expensive, then, I think it could be quite good for domestic companies in the US. So I think small caps is an interesting play as well. Let's stop it there, and thank you all for joining us. And don't forget that you can join our community. Just go to pensioncraft.com/membership. And thank you for the contribution to today's vet bill. I appreciate that. And thank you for joining us. And we'll be covering the Bank of England this week as well. So tune in for that. In fact, that's going to be tomorrow at 6 o'clock. So if you're in the UK, join us then for my take on the Bank of England's policy decision, which could be interesting. Anyway, thank you for joining us, and we'll probably see you tomorrow.